Hello, this is Ryan Ray of AAII. We are talking about the latest and greatest from the world of finance and investing for the individual investor. We're broadcasting, and if you're watching this in the archive, we do post our upcoming live show schedule on aaii.com/webinars, and AAII members do have access to the full archive of shows. My guests today are Derek Hageman, Craig Israelson, and Gaddis and Grayson Rose. Today's show has three topics. How virtuous is your portfolio? The first segment of this episode reveals a first cut list of promising stocks that incorporate environmental, social, and governance characteristics, otherwise known as ESG. Next, we looked at the impact of asset allocation on retirement income using two popular withdrawal strategies. Finally, we preview a special virtual local chapter event where a father-son investing team will discuss how to equip the next generation of investors with investment knowledge. Let's get started. Derek, for one of our April first cut lists, you took a look at virtue stocks. I wanted to start off with a question that actually came in from a member. They ask, what is the measure by which you determine what qualifies or does not qualify as a virtue stock? Is this a subjective measure, or how do you identify virtue stocks?
That's a good question, Ryan. So I'll just start by saying that there really is no single universal standard by which to determine what qualifies or does not qualify as a virtue stock. So generally, virtue investments, they're labeled as being socially responsible investments. So strategies focusing on this, they can encompass environmental, social, and governance characteristics, or ESG. And they really seek to align a portfolio with an investor's personal beliefs. And like I said, I mean, there really is no single universal standard, but investors can look at the holdings of mutual funds and exchange traded funds, or ETFs, that follow an ESG approach as a starting universe.
So let's get into the first cut list itself. With the virtue companies you did look at, what were the factors that led to inclusion on the screen?
So our starting point for the virtue stock investing first cut, it was the iShares MSCI KLD 400 social ETF, which is a ticker DSI. That's definitely a mouthful, but that ETF, it's really based on one of the first socially responsible investing indexes. It invests in large, mid, and small cap companies with high ESG ratings to screen on. So for the first cut list, we simply looked at the holdings that are included in this ETF, and the fund's holdings can be downloaded from the iShares website. And in the article, we give a link to where those holdings can be downloaded. But this ETF, it seeks to track the investment results of an index composed of US companies that have positive ESG characteristics as identified by the index provider. So in this case, the ESG metrics, they're based on the MSCI ESG fund ratings. And iShares notes that sustainability characteristics, they can help investors integrate non-financial sustainability considerations into their investment process. And we chose to focus on a growth-oriented strategy, and specifically the screen required stocks to have realized higher revenue growth than their industry peers over both the past 5 years and the past 12 months. And this narrowed the results to the companies with the highest growth rates within their respective industries. And there were some additional growth metrics included as well.
All right, you just mentioned that stocks in this screen were required to have higher revenue growth over the past 5 years and the past 12 months, and then some additional growth metrics attached to that. Were there industries on this list that found themselves more represented than others in this regard?
Yeah, right. So just to the first part of your question, in addition to the revenue growth, the screen also required the IBIS consensus estimate among analysts to project annualized earnings per share growth rates of at least 5% for the current year and the next 2 years. And so that actually narrowed the list to the 20 virtue stocks with the highest expected growth rates for their current fiscal year. And you asked specifically about sector and industry representation. So yes, if we look at the list by sector, the healthcare sector was the most represented than any other sector. There were actually 5 of the 20 stocks from the screen are healthcare related, and there were 2 of them that were from the pharmaceutical industry. One of the companies was Jazz Pharmaceuticals, ticker JAZZ, and another one from the pharmaceutical industry was AbbVie, which is ticker ABBV. So definitely the healthcare sector was the most represented.
As a reminder to our viewers, the first cut list is a jumping off point for stock ideas, but let's say you're someone interested this time around in investing in virtue-oriented stocks. What would be some considerations associated with this sort of thematic investing?
Well, ESG investing, it definitely remains a very personal decision. So ESG investors, they need to take the time to really look under the hood themselves and understand the rules governing the different ESG indexes that ESG funds track. And really, they want to do that to ensure that the fund's social screens are aligned with their own values. Even broad-based funds have some important differences in the criteria they use to include and exclude securities. And ESG selection criteria, it can result in different industry biases with consequent risks. So those are definitely some considerations.
Well, thank you for your time, Derek. If you'd like to learn more about the Virtue Stocks First Cut List, I would check out Derek's article in the April 2021 AAII Journal. The article is simply titled Thematic Investing for Virtue Stocks, and that's available both in the print edition and on AAII.com. Thanks, Derek.
Thanks, Ryan.
Many retired investors are aware that how much they withdraw, either by choice or by law, from their retirement portfolios each year is influenced by the asset allocation of their portfolio. How much is that amount really, though? And what would the trade-offs be if you built a more aggressive or conservative portfolio? These questions are the subject of a recent article AAII Journal contributing editor Craig Israelson wrote. Craig teaches as an executive in residence in the personal financial planning program at the Utah Valley University in Orem, Utah, is the developer of the 712 portfolio, and he's the author of 3 books. Welcome, Craig.
Hey, glad to be here.
Craig, I want to start off by asking about this retirement portfolio analysis that you did. What sort of time horizon are you examining, and what sort of factors are you looking for?
So the key element here is to look at enough rolling periods that we don't just cherry pick the ideal period or cherry pick a horrible period. And when I say period, I mean these are 25-year periods that try to simulate the typical length for a lot of us in retirement. So that would be from age 72 to 97-ish. So there's a whole bunch. In fact, there's 27 rolling 25-year periods between 1970 and 2020. So that's the time frame.
Gotcha. And then one thing your article addresses is required minimum distributions, or more popularly known as RMDs. These are the minimum amount of retirement. The minimum amount a retiree must withdraw from their account each year. What are the assumptions here for folks looking forward to their RMDs as they consider their portfolio allocation? Will they have enough money to survive the rest of their lives?
Yeah, the simple answer is yes, because you're only taking out a percentage. And so when you take out a percentage, you really can't liquidate it. What would cause a portfolio to fail would be some really bad investments. But if it's prudently invested, which is the only way that AAII members invest, then it's not the withdrawal rate that's going to kill it. I mean, that's a huge takeaway, so that we can live with less fear. And that's why I do a lot of this research, is it has a human sort of emotional component, which is if our portfolio really will survive, but we live every day thinking it won't, then that's kind of like living every day thinking I'm going to get cancer today. It just sucks the fun out of life. And so the RMD is often looked at as kind of like the enemy because we're forced to do it. And if our if our behavior with regard to masks is any indicator, we don't like to be told. And I appreciate that. I don't think I'm a whole lot different. I don't really like to be told what to do, but the RMD is a percentage-based system. So the first withdrawal rate, the percentage rate at age 72, or I should say the first year, because that number keeps changing, and it could change even more. It could go to 74 for all we know, is just under 4%. And then it escalates a little bit every year, and we're forced to take that money out, have it taxed. That's why this whole thing is happening. And then either we live on that money or we reinvest it into a non-tax deferred account, which you certainly can do if you don't need to use it all. So with that RMD as the operational mechanism of how money is coming out, if we assume a starting balance of $250,000, then, and here's where the article gets kind of involved, because I'm looking at all kinds of different portfolios. But if for the sake of this question, we just look at a 60-40 portfolio, 60% stock stuff and 40% fixed income stuff. And again, $250,000 is the starting balance. Then the average withdrawal over each 25-year period. So the average withdrawal per year over all of these rolling 25-year periods is just under $40,000. Okay, that's not the first year, and that's not the last year. It's not year 1 or year 25. That's the average of this 25-year period, the next 25-year, and there's a lot of numbers going into that average. And so I wouldn't get too wrapped up in that exact number, but to have, some sort of a finite answer to that kind of question. So the nice thing is this: if we assumed $250,000 as the starting balance and a 60-40 portfolio, the RMD is governing the withdrawal. We're about $40,000 annual withdrawal. And you say, well, my portfolio is not $250,000, it's $1 million. Well, that's 4 times 250. Well, then just take that number of 40,000, multiply it by 4. So your average withdrawal would then be about 160,000 out of $1 million portfolio. So that's the beauty of this kind of analysis, is that the starting balance is a pivot point, and you can use a multiplier to get up to what your starting balance would be and apply that multiplier then to all the results.
Your article gets into two different asset allocation models. If you were, let's get into the more aggressive one. What is the aggressive part of the allocation in this scenario, and what are the risks associated with one?
So the most aggressive I looked at, I'm calling 100% equity, and 100% equity in this article is 50%. So you have a portfolio with 50% in large cap stock, 25% in small cap stock, and 25% in non-US stock. And the data I'm using are well-known indexes: S&P 500, Russell 2000, Morgan Stanley EFA index for non-US stock, and so forth. So these are not the returns of specific mutual funds. These are the returns of well-known, vetted index annual performance figures. So the risk of an all equity portfolio, and think of it this way: 2/3 of it is in the U.S. stock market. 75% of it is in the U.S. stock market, and 25% is in the non-U.S. a variety of non-U.S. markets. The risk is not all bad. I mean, there's some good sides to that risk. The upside is that your average annual withdrawal would move from 40,000 to about 52,000. And remember that 40,000 figure was the classic 60-40 portfolio.
Mm-hmm.
So if you go to no fixed income, all equity, you raise your average annual withdrawal through the RMD by about 12,000 bucks. Okay, so about $1,000 a month. So that's pretty easy to remember. But the downside is that 22% of the time, your annual withdrawal will go down. Because remember, the RMD is a percentage, and you're pulling out a percentage of the portfolio. And if the portfolio had more volatility, that means its performance may have been negative. So now your balance has gone down. You take out a percentage of a smaller balance. That means your annual withdrawal after a year like 2008 is going to be smaller.
Mm.
Okay, and so that phenomena where your next year's withdrawal goes down, that phenomena is more magnified in all equity. And as you put the portfolio with some fixed income indexes with bonds and cash, then the frequency of your next year's withdrawal going down decreases somewhat. That's one measure of risk in a higher equity portfolio. There's the obvious, just the volatility of the returns themselves. But everything in this article, we're trying to focus through the lens of how does it impact average withdrawal? How does it impact average ending balance 25 years later? Those kind of things.
So in this article, you looked at the other end of the scale, the conservative side. And if you're wired like me, you tend to be perhaps a bit more conservative in your investing style. For folks looking at this more conservative model, what is conservative about the allocation that you looked at, and what are the trade-offs perhaps associated with the other end of the spectrum?
Yeah, so if the aggressive, so to speak, is all equity, then the conservative is all fixed income. And in this case, it was 80% bonds and 20% cash. And remember, in a multi-asset formulation of a model, we're assuming that it's rebalanced every year. Because if you start off with an allocation, in this case of 80% bonds, 20% cash, over a 25-year period, then what you're saying is that at the start of every year, I'm 80% bonds, 20% cash. Well, the only way to get back to that original allocation is to rebalance. So as you read through research in the AAII journal or wherever, and they mention that the portfolios were rebalanced, that's an important thing because that takes a little bit of effort to do that. And it takes some courage to do that, because the thing that you're rebalancing into is the thing that didn't do as well last year. And I've written a number of articles on rebalancing, and I'll do one for the journal that talk about the emotion of rebalancing, and it's easier said than done, just because of our human tendency to stay away from things that are sharp and poisonous. And that's what it feels like if we have 10 mutual funds and 4 did bad and we put more money into those. Well, that's rebalancing. So the conservative all fixed income retirement model that's being subjected to RMD, again, $250,000 assumed starting balance. The average withdrawal was about 25,000. Okay, so think about that. So all fixed income, $250,000 start, average withdrawal over all of these rolling 25-year periods is about 25,000. On the other side of the spectrum we just talked about is the all equity. That's about 52,000. So the impact of asset allocation can basically double your average annual withdrawal. That's pretty much what it can do. It can double it. And that's not a small thing. And then, of course, you have all the gradients in between, because I don't think, well, I mean, some people might be all equity, all fixed income. I would guess more of us are somewhere in the middle. We've got a bit of a blend. But that gives you the bookends. So through asset allocation, you can basically double your average annual withdrawal. But this is interesting. The average ending balance for the all fixed income was about $290,000. Again, with a start of 250. So the all fixed income more or less held the portfolio balance constant. You know, it's going to fluctuate, but that was the average ending balance, about 290 in the all fixed income. So you have two masters. You have the master of how much money can I take out, and you have the master of, well, I don't want to kill this thing. I want to have, you know, at least what I started with, you know, maybe as a goal 25 years down the road. And those are competing with each other. Whereas the all equity model, other end of the spectrum, the average ending balance there was about 850,000. So when you move from fixed income, all fixed income, to all equity, you basically double your average annual withdrawal, but you triple your average ending balance. And that's a really interesting result, that they're not both doubling. Now, the sort of the upside or the benefit of an all fixed income portfolio is that your average, that your annual withdrawal goes down the next year about 16% of the time. And by an average about $1,200. That's in the all fixed income. So roughly 16% of the time, your next year's withdrawal is smaller by an average of about $1,200. In the all equity model, it's 22% of the time that your withdrawal went down by an average of $9,500. So you have a frequency and a magnitude issue. Because one of the things that people don't like about the RMD, aside from being forced, is that it means they don't know how much they'll be taking out. It could be more the next year, it could be less the next year. And if they want this constant amount of money that they're withdrawing just for budgeting purposes, the RMD doesn't accomplish that. Nor does a 4% withdrawal rate that we just self-impose. So in other words, people have accounts that are not governed by RMD, such as a Roth IRA. Okay, well then a Roth IRA, you have to decide how much you take out if you take out. Okay, well, how do you decide? Well, a lot of people use a 4% rule. Okay, so in a 4% rule, what that means is the amount you're taking out each year will fluctuate. And sometimes it fluctuates up, sometimes down. And the down maybe is fine for people. But I just know from visiting with advisors and investors that, you know, some of us really like to have this kind of set figure. I'm taking out 40,000 a year or 20,000 a year. And they don't like the idea of taking out less. And this is a really, really vital point. I know that not knowing how much you're going to take out the next year can be a little bothersome to people. But the reality is, if you only take out a percentage, then you won't kill the portfolio. So the downside is you don't have this certainty for your budget. What's the upside? You're not going to kill it. Well, which of those is more important? This one. You're not going to kill it. That's the more important issue. And so we put up with a little bit of uncertainty for the assurance that, you know, a modest withdrawal rate, and 4% is, and by the way, 5% is pretty modest too. You know, if you're building a 60-40 portfolio for retirement, I mean, you think back, a 60-40 model over the last 50 years has averaged about 9.5% return. 9.5. And if you're taking out 4 or 5, I mean, this part's not rocket science, Ryan, is it? If you're making 9 and you're pulling out 4, you know what's going to happen to that barrel of money? It's going to grow. And that's hard for people to sometimes keep in mind, is if we're living in fear and we view our retirement portfolio as a bucket full of water. If we're living in fear, our only thought about that bucket is it can only go down in value. The reality is, no, if you stick to your plan, build a broadly diversified, well thought out portfolio, don't overmanage it, don't overthink it, don't overreact, it's going to grow, even if you're taking out 5% each year.
Well, and I think that's the key point, and probably something that you said earlier, is a bit of a challenge, is sticking to the plan. And obviously you're talking about extreme theoretical models, and an aggressive and a conservative model. But obviously, nobody retires in a theoretical time hole. We live in a reality with market considerations and outcomes. What if the performance of these allocations changes over time? Right as the investor is considering retiring, or perhaps in the next 10 to 20 years, what would you say to those folks?
Well, I'm there with you.
Sure.
The article actually examined that. So what I did is I went in and looked at the same scenario, RMD. Well, actually, the article focused on RMD withdrawals and a 4% withdrawal rate. And so I subjected each of those models to a 50% reduction in the returns of whatever is being invested in. So if it was large cap stock, then I reduced the return of large cap stock by 50%. If it was bonds, I reduced the return of bonds by 50%. So I introduced a fairly draconian view of the future. Well, I imposed a draconian view on the past and played that out as if it was the future. And that's the whole reason we do analysis. We're trying to get some hints from the past and parlay those, or envision those as sort of our guardrails for the future of where things can go. And what happened when you look at lower returns? So let's just go back and get our bearings here. So one of the key figures to think about is the 60-40 portfolio. And the 60-40 portfolio, assuming $250,000 starting balance at age 72, our average withdrawal under normal actual historical returns was about $40,000. Okay. Same 60-40 portfolio. Now we reduce all the historical returns by 50%. Now our average annual withdrawal in that 60-40 is about 21,000. So we go from 40,000 to roughly, call it 20,000. So a 50% reduction in returns, not surprisingly, produced about a 50% reduction in our average annual withdrawal. Now, what's interesting is, remember, we had our ending balance was actually higher by 3 times if we went from all fixed income to all equity. And so we noticed a similar phenomena. Our average ending balance with lowered historical returns was lower by about 2/3 compared to normal returns. So in a 60-40 model, if we move to a very pessimistic view of the past, average amount we took out each year went down by half. The average ending balance went down by 2/3. But the key takeaway is that we never killed the portfolio. And it doesn't matter what happens to returns, we're not going to kill it. We just can't draw as much out of it. That, I think, is the most important takeaway if the issue is fear.
Understood. Well, thank you, Craig. I think that helped a lot of folks out. Before we go, I want to have people be able to find you and your work. Where can they do so?
Well, usually my fingerprints are up in the post office. It's just a joke. Probably the easiest way is my website, which is 712portfolio.com. So the number 7, the word 12, TWELVE, portfolio.com. virtuous.com. And I think if you go there, there's a library section, and there's a lot of stuff you can download on a variety of different topics. And I'm not the brightest tool in the shed, but I have produced a lot of stuff over the years, and there may be some things that are useful or helpful. Feel free to download those.
Since we were talking about it, if you'd like to learn more about this topic and you're watching at home, you can look for Craig's article in the April 2021 AAII journal. The article is simply titled "The Impact of Asset Allocation on Retirement Income." That's available in both the print edition and on AAII.com. Thanks again, Craig.
You got it. Thanks, Ryan.
Our local chapters, led by volunteer AAII members, organize regular educational meetings with speakers in their local areas to provide unbiased investment education in a social context. Of course, because of the pandemic, they are meeting remotely on Zoom these days, but the education is still being spread far and wide. I wanted to highlight an upcoming special chapter webinar from our Los Angeles and San Diego chapters that features father and son investing duo Gaddis and Grayson Rose. Gaddis is a private investor, author, and blogger of StockMarketMastery.com, while Grayson is an author and vice president of StockCharts.com. Both are private money managers of their own respective accounts and work on Stock Market Mastery together. Welcome both of you to the program.
Great to be here, Ryan. Great to be here.
I want to start with you, Gaddis, and if you don't mind, a personal investing question. At what point did you begin talking about money with Grayson?
Now Grayson turns off the video or the mic here. The poor guy, it started him at dinner table as soon as he was old enough to sit down at dinner table with two MBAs. So he was listening even before he could probably talk. But I would say, in answer to your question, Ryan, probably in earnest when he was about 10 years old, because I had been teaching part-time at Bellevue College for 20 years. And when he was at about 10 years old, I actually had him, I taught him how to draw trend lines on charts and had him come to class. And the students would toss ticker symbols at him. He'd pull up the charts, and with his big yellow pen, pink pen, whatever his favorite color was, he would either draw uptrends, sideways, or downtrends. And I think it impressed a lot of the students that were, this is continuing education, so average age of the class probably 55, that here's a 10-year-old that could draw trend lines pretty accurately. So, and then when he was a teenager, I encouraged him to buy a stock in a favorite company of his, which I'm sure he'll bring up, called Zoomies. So we sort of wrapped the stock into this stories and the lessons, and explained to him what money meant and how the stock market meant. And it was a good message, and it started early and it continued. Obviously, the emphasis that we wrote in our book as well. A lot of people jump right into, oh boy, I want to invest in the stock market, and they forget about actually building wealth and protecting it before you try to grow it. And so there was a lot of talk around the dinner table about, asset protection first, and then always, the best investment you can make, Grayson, is in yourself. So that was something that my wife and I both preached. And then obviously, I just happen to have, when you write a book together, it's a great way to pass the baton, so to speak. And now we do manage one little account together that's for his kids. Of course, he's 27 years old. He's not married and doesn't have any kids. So that's an interesting sort of objective.
So with Grayson, did you place more emphasis on how to invest or how not to invest? I guess, did you take it really to a more positive or perhaps negative perspective?
If you remember, or you listen to Warren Buffett and Charlie Munger, they're always preaching that it's more important not to be a stupid investor than it is to be brilliant. And I remember this, Charlie Munger had a somewhat candid quote. So he said, it's remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid instead of trying to be very intelligent. And so that always stayed with me, that if you can avoid the blunders, that was almost as important as avoiding the blunders, avoiding stepping in the cow dung, was very important. And I know those of you that know William O'Neill, who is the founder of Investors Business Daily, he has a wonderful long list of blunders that he's seen, potholes that he's seen investors step in, and he writes about it and tries to get them not to do that. And things like, start saving early, the whole lecture about credit cards and debt, stubbornly holding on to your losses and claiming you're right and the market's wrong, not being able to make up your mind when you see an opportunity before you, and and then of course always controlling your costs. And I have to salute you guys at the AAII. The other day, you came out with an article, and it was something I'd been using for years, of just about costs and how important costs are. Was the Vanguard 500 index compared to the Ridex S&P 500 funds. They're both funds and exactly the same portfolio, but the expenses on the Vanguard were 4 basis points, and on the Ridex were 243 basis points. And I calculated that over 10 years, you made 24% higher return by being in the Vanguard. The ticker symbol was VFIAF, simply by watching your costs. So that was always something that I preached to Grayson about, watching costs, and costs matter. So those sort of things. I don't want to give away the whole LA talk, but that was the gist of it.
All right, Grayson, let's turn to you. What was it about investing in the stock market that hooked you at a young age?
It's a great question, Ryan. And there were definitely a couple of things. I mean, first and foremost, I grew up with a father who was a full-time trader, full-time investor, for a living. I would go down to his office, during the trading day, and he'd practically lock the door because he said, the markets are open. I'm doing stuff, leave me alone. So no, I'm kidding there. But, a part of it for me was just kind of always wondering, what dad did, and wanting to kind of learn more about what my father really kind of did for a living. But as he started kind of tutoring me and showing me around the charts, showing me around the markets, teaching me about what the stock market really meant, there were definitely a couple of things that hooked me. One of them that Gaddis kind of mentioned there, alluded to, was the Zoomies stock purchase that we kind of made together. So I was a kid who loved skateboarding. That was kind of my big passion. I tell this story a lot in seminars and things like that. I loved skateboarding, and one of the stores that I always wanted to go to buy, shoes and skateboards and all that stuff was a company called Zoomies. It turned out it was actually a publicly traded company. And so my dad sat me down and said, you're always pestering me and mom to take you to Zoomies and spend all this money at the mall on, new skateboards or something. But in reality, that's a publicly traded company. Instead of spending all your money at Zoomies, you could own Zoomies. And there was a part of that as, an 11, 12, 13-year-old kid that really resonated with me. The idea that I could actually own Zoomies, I could go into school the next day and say, hey, you bought that sweatshirt at Zoomies. I own Zoomies. You bought that sweatshirt from me. It was just kind of funny for a young kid to kind of wrap his head around that. So it hooked me, this idea that you could actually sort of love companies and then go and buy the company, and you could own stock in this company. That really hooked me. But the other thing that was coming to mind as Gaddis was talking there, about the lessons that he tried to teach me and everything. Really, my introduction to the stock market actually came in the end from a sort of a saving perspective, and I've always carried that forward. What I mean by that is that when I was a young kid, my dad made a deal with me, and he said, hey, if you want to buy a car when you're 16, I was a big car nut. In addition to my love of skateboarding, that was the other thing that drove me, was a passion for cars, still is to this day. But my dad said, hey, if you want to buy a car when you're 16, you got to pay for it. I'll pay for 1/3, but you got to pay for the other 2/3. I'm not just going to buy you a car when you're 16. So we actually made that deal when I was about 10, 11 years old. And so from that age forward, I was constantly trying to save money for a car. And, it's one thing when you're washing windows, or, going down to grandma's house or something to try to sweep her porch and make a couple of bucks. But as my dad started to introduce me to the stock market, and I saw that, hey, I could buy a company like Zoomies, a stock like Zoomies, take that money, and it would actually appreciate if I, make a great trade. And now I'm making money while I'm sleeping. That really started to hook me. So, it kind of came from this place of trying to save, and getting hooked into the stock market, because I just saw the power of it from a really young age. So it was a lot of things. It was a lot of things that really kind of hooked me on the markets early on.
That makes a lot of sense about, being attracted by brands that you liked as a child. You mentioned that young investors have an edge, and that their age gives them an advantage in the markets. Why is that? Why do you think that is?
That's a great question too. I have said that for a long time, and actually the Zoomies case in a lot of ways is a great example of it, where, I sort of had an edge in that because I was a young kid who liked Zoomies, who saw that this was a business that all of my other friends were shopping at. And so, my dad kind of globbed onto that because he was the one, swiping the credit card there at Zoomies when I was 11 years old or whatever. But I had an opportunity to really kind of see that trade, not just on the charts and not just from sort of the data that we were looking at on the screens, but actually I had an opportunity to kind of be what I now call observational with it and say, I'm spending a lot of my own money at Zoomies. This is a great company that's really resonating with, a younger generation and a younger group of shoppers. So I do think that younger investors really have an edge in the market because you see the world from a different perspective. There are so many businesses that are trying to attract younger generations, whether it's apps or clothing companies or really anything. So many businesses out there are trying to go after that younger generation. And so as part of that younger generation, I think you do have an opportunity to say, here are the companies that really make a lot of sense to me. Here are the companies that my friends and I are spending a lot of money at. I'm going to go start to research those stocks because these are the businesses that are going to continue to grow and that are going to continue to outperform the market, things like that. So I think being a younger investor, sort of bringing that observational approach to your market analysis, your market research, your investment analysis, I think it really does give us a younger generation, gives us an edge, an advantage in the markets. So.
Well, I think it'd be appropriate to close this segment with a similar set of questions asked with the generational perspective in mind. Let's start with you, Gaddis. What do you feel are the biggest roadblocks preventing our young people from raising their money management IQ, as it were?
Biggest impediment is just the family taboo not to talk about money. It's just terrible. Amex a few years ago did a study that said 90% of the families that they surveyed consistently come up with reasons not to talk about money with their spouse and with their kids. And so, sure, that makes today comfortable, but if you don't talk about it today, putting off the consequences in the future is disastrous. I happened to be in Japan in 2019 on a tour, and there was a woman who I'll just call her Adele. She had worked in a very famous family office for 30 years, and there were hundreds of very wealthy, rich kids. And she made an interesting observation. She said, by 25, they're done. They're either the way they are at 25 is the way they are. And if you haven't taught them about money and money management, don't expect them to change. So I think a big impediment is people think investing is all about numbers. And if it's not about numbers, it's about understanding people's needs, understanding your values as a person and your family. And, if you don't learn money management now, you're leaving yourself, your kids, or in my case, looking down the road, when I pass, you're leaving them to sort of the merciless school of experience, which will be much, much more painful. So if you're honest about your own triumphs, and I certainly felt like I tried to be with Grayson about my wins and my losses. And if that doesn't work, mentoring, finding an uncle or somebody else. I know that I was involved with Big Brothers Big Sisters for 25 years, and I felt like I did a reasonable job with my little brother. I'll just call him T. I remember once he asked me for a loan for Friday night for $20, and I had him sign a little piece of paper that said, I'll pay you back on Saturday when I get my paycheck, but I said, I'm going to charge you 1% interest a day. Well, a couple of years later, I presented T with the bill for the amount of money he owed me. And the lesson was, don't use credit, don't use leverage, don't use, that kind of thing. So those are the kinds of lessons I tried to use with my own son. But I think people have to get over this taboo of talking about money around the dinner table. I think that's a big impediment.
Sure, I've certainly experienced that myself, and certainly in my workplaces and my family also. Grayson, I guess talking to some of your dad's points, how can we encourage those in the younger generation to get started in the markets earlier?
Yeah. I think a big part of it does come from families, like Gaddis is saying, being willing to talk about money more, be more open with those conversations. It is funny that taboo exists, but really, I think the biggest thing, something that I'm hoping that I can get more and more involved in, as time goes on. I am completely confused as to why we don't have standard financial education in high schools and in colleges. I say it a lot of times when I talk about this point. I had a great time, like I mentioned. I was a car nut, growing up, and so I got to take small gas engine repair in high school. The most fun class that I took by far. I mean, I got to fix motors in the middle of the day and get all greasy and everything. It was just a ton of fun for a kid who loved cars. But the fact that I got to take that class in high school and wasn't forced to take any sort of financial education class at all, and really didn't even have an opportunity. It's not just that I wasn't forced, but I didn't even have an opportunity to take any sort of standard financial education course in high school. I think we really are doing our students, our high school grads, our college grads a disservice, especially when you think about, all the college students that are taking out so much incredible debt at such crazy rates to finance their education, which is great. They should be going and getting that education. But when we leave those students with no tools really to understand what kind of situation they've ended up in, to understand how to start investing, to understand how to pay back some of those loans and things like that. That's something that I feel so passionate about. We need more financial education as standard curriculum in high schools and in colleges. I think that really would go a long way. It's encouraging, though, I will say, to see so many platforms, even like, some of the new brokerages on the street, things like Robinhood and things that have really lowered the bar, to see, YouTube and all of the content that people are putting out there with, it's a mix. There are things that are crazy that people shouldn't watch, but there are also fantastic content creators putting out great financial education on platforms like YouTube, and it's all free. I'm so glad to see that. And I will say it's been funny, this last couple of months with all of the GameStop craziness. There's been this whole generation of younger investors that started buying, GameStop stock and got, sort of introduced to the market through this craziness, which on one hand is frightening in a lot of ways. But at the same time, I think what that actually may have done when we think about, 10, 20, 30 years down the road, a lot of those younger investors that started buying GameStop stock, my hope is that a lot of them have been introduced to the market in some way, and it will actually start to create a generation that's more open to learning about the markets, getting involved in investing. They've sort of seen what this is. They've seen how it can affect them and how it can help them in a lot of ways. So I'm hoping that even those crazy stories like GameStop will actually start to chip away at this problem of sort of a lack of financial education. So many things, but if anyone out there is listening and you've got a way for me to get involved in more financial education for high school and college students, give me a call, because that's something I feel so passionate about.
Well, I think you can probably use the soundbite of this clip and share it around if you ever get interviewed for that.
There we go. There we go.
Well, I want to thank you both for joining me for this. If you
Yeah.
are interested in hearing more from Gaddis and Grayson, I'd encourage you to join them on April 17th at 9 a.m. Pacific time at the link shown on your screen for a 3-part presentation from the two of them. Registration is free, and you will receive a confirmation email when you click that link containing information about joining the webinar. Again, this is from our Los Angeles and San Diego chapters. So if you'd like to help offset ongoing chapter expenses, a voluntary contribution of $5 or $10 is requested, and you can make that at AAIILA.org or AAIISanDiego.com. Thanks again, Gaddis and Grayson.
Thank you,
for having us,
Ryan. You're a wonderful moderator.
Hi, folks. Host Ryan Ray here. Just wanted to remind you that if you did have questions for our listener mailbag segment, feel free to submit them in. If you have a question for us, you can submit them using the questions panel in your GoToWebinar control panel, or you can email me rreeh@aaii.com with the subject line II Show question. We do try to feature questions that you submit and answer them in the next episode of the show. Thanks. If you liked our show, please visit aaii.com/webinars to register for more webinar and video content. You can like us on Facebook. I also invite you to follow us on Twitter at @AAII_invest_ED. For more investing education, I invite you to check out our website, aaii.com. Again, I want to thank our guests, Derek Hageman, Craig Israelson, and Gaddis and Grayson Rose. And of course, you for listening and watching. We'll see you next time.